I think this is what I'm going to do. Like I said, I think we have a small group here, and since quite a number have already bought REITs, I actually want to spend a bit more time also going through what are some of the REITs current situation, or how I actually build my REITs portfolio on the web, giving more examples. So hopefully that one is actually more interesting to you. So I just want to share with you at the end of the day, what are we trying to achieve here? Okay. So eventually, okay, buy REITs, buy REITs is very clear, the objective. If you can recall, for REITs, what is one main objective that we actually want to achieve? Is it to accumulate wealth? Is it for protection purposes? Or is it to generate passive income? Can I just trouble someone to share in the chat? So when we actually use REITs, okay, so every instrument has their main objective. So when we use REITs, what is it actually used for? Is it more for wealth accumulation? Is it more for generating passive income, or is it more for protection? So these are the three main objectives we always try to achieve. Again, can I just trouble someone to share in the chat now? Which one of these objectives the REITs is actually very good at helping? Okay, thank you so much. It is passive income. So I just want to share with you at the end of the day, what we are trying to achieve when we invest in REITs. So this is one of my REITs portfolio. So you can see that eventually, okay, I'm not there just buying one REIT, just, you know, what I'm trying to show you here is this. I'm not here just trying to think of out of the 39, which one is the best REIT and just bet all my money there. No, as you can see, I'm actually well diversified in a lot of REITs. And of course, I'm not going to lie to you, certain REITs perform better and certain REITs actually fail to us. Again, I'm not going to lie to you, I'll be very open about it. I actually also bought Eagle here. Okay, but because as you can see, it's so well diversified. Okay, if let's say anything of them go wrong, okay, it doesn't hurt the portfolio very badly. At the same time, of course, if let's say certain REITs do well from a portfolio perspective, it actually may not be super exciting. But you know, end of the day, we are very clear, okay, what we actually want to achieve. Okay, if let's say, for example, if I want to accumulate wealth, that means I want to gun for capital gain. You know, I actually want to grow my money. Okay, there are better instruments than REITs. So why for REITs I do this is because, as I mentioned just now, it is for passive income purposes. Okay, and because I actually want it to be like a regular passive income. So a diversified portfolio, okay, will best actually help me to do so. Also, in the event that let's say one of the REITs don't do well, like Eagle, okay, so not to worry, my whole portfolio perspective is actually still doing very well. So this is what we actually want to try to achieve, or this is what I try to help achieve, to have a portfolio of REITs. Of course, today we actually talk about how do I actually select all these REITs. How do I actually buy them? That is a more important question. So before I go into detail, I just want to show you one more thing. So this is the screenshot of my last month statement. Okay, can you see this is the screenshot of my last month statement? So again, this is what to achieve. Yes, you can see that maybe the dividend is actually not very exciting right now, $20, $29. But what I've done here is this, I've actually opened a tab. Okay, I've actually opened a tab. Okay, of course, starting when you do it, it depends on how much you put in. Okay, the dividend may not be exciting, but you think about it. Okay, you think about it. If let's say the tab's open, then you keep feeding on tab, eventually, this is a very good source of passive income. Okay, so I hope everyone is actually clear on what we try to do. Okay, it's not just finding out which REIT is the best REIT to buy. Okay, it's actually building a REIT portfolio. And what do we actually want to do to actually generate passive income? So of course, this one don't happen every month. This one don't happen every month. Most of the REITs, they actually give per quarter. Of course, it doesn't mean that it's always on April, June, you know, okay, that quarter. So it actually can come in different months. So yes, certain months I have more dividend coming. Last month was actually very good. You can see a lot of dividends coming in. Okay, certain months I have lesser. So this is what we actually want to achieve. And the good things about holding REITs for long term here is this, if let's say history is a guide, what happened? If let's say history is a guide, you can see let's look for those that have for been a very long time. Let's say, for example, Maple Tree Logistic Trust. Okay, so can you see if let's say history a guide, assuming you actually bought even in 08, 08 at about $1 whatever, okay, the price is also high. Of course, if you actually bought at that's you can actually bought cheaper. Okay, during crisis period, it was really like 30 cents, 40 cents. Okay, can you see how much it actually has gained? And if we will look like Keppel, Keppel DC, like for example, Keppel DC recently hasn't been performing very well, but let's take a look. Keppel DC. Keppel DC. Okay, if you actually have bought it when it was IPO, it's actually about $1. Okay, so I'm not so worried that, let's say for example, even if I buy it here about 250, 260 or whatever, I'm actually not so worried lah. Yeah, because end of the day, I'm actually there for long term. And what I'm trying to show here is this from a very long term perspective. This drop, you think about this, this drop, you look at it from a 10-year perspective, it's almost what do you call that? It's almost negligible. Okay, so that's why for REITs, it's about portfolio, it's about building a portfolio. I'm not here to buy and sell REITs. What I actually really want is to have that source of passive income. And this is what this course or this today's segment is about. How do I actually do it to build a portfolio? Okay, if whatever I said past 5 minutes makes sense to you, don't mind just help me type a 1 into the chat. If there's any question, please ask. So end of the day, we want to have the objective be very clear lah. Okay, so I'm not here trying to share which REIT is the cheapest REIT right now, which REIT is the best REIT to buy right now, but rather how do you actually build the REITs portfolio. Okay, good. Thank you so much. Really appreciate your feedback. Okay, so with that, I'm actually going to share with you at every month, at the end of every month, eventually what do I do? Okay, at the end of every month, eventually what do I do? So that, after a long time, I believe this one was over, I can't remember, I think 2-3 years. 2-3 years. So what I did for this is this one, I think over the past 2 to 3 years, every month I just buy either 1, 2, or 0. Okay, either 1 REIT, 2 REIT, or 0 REIT every month. Okay, and every time I buy a REIT, it's always in $1,000 for this portfolio. Okay, so today I'm actually going to share with you how do I actually set the rules so that I actually build up this portfolio. Okay, now let me just go back to my slides. Okay, good. So same thing, not stock tips. Make money, be happy, lose money, don't scold me. Okay, I think for REITs, for the initial part, I probably want to go a little bit faster. So do stop me if there's any question. Like I said, we have a small group today. I'm hopefully we can have this session a little bit more interactive. Any question, please stop me. If not, I will just go through a bit faster. So REIT, I think hope by now it's very clear. Buy properties. Okay, you're actually buying properties when you actually invest in REITs. So now I am not only owner of about 50, 60 large companies in Singapore. I'm an owner of DBS, I'm owner of UOB, I'm owner of Singtel. Okay, I am also a multiple global property player. Okay, so it's very good to be a Singaporean now. All you have to do is buy a lot of stocks, buy a REITs. You're not only an owner of large companies and you're multiple property player. So I'm not boasting. So even though the REITs probably I own about 0.0001% of the particular property. Okay, that don't deny the fact I'm not an owner. So you also can be an owner like me. Okay, so this is what the REIT does. Okay, give you access to owning large properties not only in Singapore but also overseas. Okay, so why is REITs very good at giving dividends? Okay, why is REITs very good at giving dividends? So in fact, this is the only instrument listed in the stock exchange. In fact, in most stock exchange, whereby based on black and white, they must give dividends. It's a must. Okay, there is a black and white rule saying that they must give dividends. So in Singapore context, or in fact in most countries, at least 90% of the profit have to be distributed. So sometimes they can even give up to 100%, but minimum they have to give is 90%. Okay, so like for example, your blue chip, your DBS, your UOB, yeah lah, every year they give dividend, correct? But if let's say certain year they don't feel like giving, they can, but REITs cannot. Okay, they must give dividends. Then there's this mandatory debt ratio limits. They can only borrow up to 50% now, 50%. Now, can I ask you this question? If let's say, for example, you want to buy a private property and it's your first private property, how many percent of the property can you borrow? Can I just get someone to guess or to share on the chat, please? If let's say you want to buy a private property, the first one. Thank you so much, 75%. Okay. So basically, you know, as an individual, you can actually borrow to 75%, but for REITs, they can only borrow up to 50% of the property. So this rule has been very good for the investor. Okay, like for example, during the whole of COVID period, we all know that during COVID period, a lot of rentals are actually being disrupted, but there are no REITs, okay, no REITs that actually get into the problem with the bank because of COVID. Okay, so yes, Eagle got into trouble, but nothing to do with COVID. So before COVID, Eagle already in trouble. Also just during COVID, anyway, it's not related to COVID. So Eagle in trouble not because of COVID. But besides Eagle, okay, none of the REITs, okay, they actually got into trouble, okay, because of COVID. So this is one of the main reasons, because they can only borrow 50%. Also in that sense, their bond is capped. Okay. Another good thing about REITs here is this: they have tax transparency. Basically, there is actually no income tax at the REITs level. So let's say, for example, tomorrow we want to buy properties together. We form a company, and the property is owned by the company. So any rental go into the company level, they have to pay corporate income tax, which in Singapore context is 17%. Okay, but for REITs, okay, at the REITs level, there is actually no income tax. Okay, and in Singapore, there is actually no dividend tax, no capital gain tax. So basically, the REITs from rental to your pocket as dividend is purely income tax free. Even if you are a foreigner, as long as you are buying as an individual name. So for those who are actually thinking of forming a company to own REITs, that one be careful, that one there may be tax involved. But if let's say you are buying as an individual name, no income tax. Okay, even if you are a foreigner. So that is the beauty of it. But please take note, no income tax. There may be things like property tax, stamp duty that wants to apply. And of course, foreigner, if eventually you want to repatriate the money out of Singapore, there is withholding tax. Okay, but income tax don't have. So these are some of the beauty of REITs. Okay. So I hope it's clear, because of the structure for REITs we are just there buy, hold, collect dividend. Okay. So once again, you know, we have actually gone through an area of products. We actually talked about stocks, we actually talk about ETF, we actually talk about REITs, for example. So we must be very clear what's the objective. Okay, like personally, I'm invested in all three. Okay, I'm invested in stocks, I'm invested in REITs, I'm invested in annuities, I'm actually invested in ETF. Okay, to me it's very clear. So why I invest in annuity? Okay, it's for protection purposes. If let's say anything happened to me, okay, if I suddenly lose my income, I know that my money is there. So this role was actually well played out last year. So last year, when the COVID started in January, I still remember I had a shock of my life. Basically, you know, once the COVID started, they say I cannot do any classes anymore. So can you imagine, I was fully dependent on classes for my income, okay, pre-COVID. And last year, they say all my classes all stopped, cannot have physical classes. So I was, can you imagine how shocked I am? So luckily, you know, I actually have, what do you call that, okay? I actually got into annuities which have certain cash value. It's a place for me to store my emergency fund. Okay, so I know that if anything were to happen, I got one emergency fund for my annuities I can take. Of course, again, luckily, I didn't have to go and take thanks to Zoom. I don't have to touch that emergency fund, but you know, I have that fund ready under annuities. Okay, so for stocks, why I buy stocks? Stocks is actually more for me for capital gain. Okay, so when I buy certain stocks, hopefully $1 can become $2, $2 can 150. I hope that I actually can get capital gain from stocks. So I actually use stocks more for my wealth accumulation purposes. Okay, so REITs is actually more for my passive income. So eventually, as I age, you can see that I'm slowly converting my stocks into REITs. Okay, I would actually visualize that on the day I retire, probably 70% of money is actually in REITs, 70% REITs. So that actually give me passive income. So meanwhile, some of my money is actually still in stocks. Why? Because I need the capital gain. Which of course stocks is better to give capital gain than REITs. Okay, again, don't get me wrong, REITs also can get capital gain, but it's not the best instrument for capital gain. Like for example, so far, I haven't seen any REITs within 1 year can get 100% gain. You can ask Jimmy lah. I'm quite sure Jimmy in his US stocks, he can close 2 eye and rattle off I don't know how many stocks within 1 year can get 100% gain. So far, I have not seen any REITs within 1 year get 100% capital gain. No. Okay. So this is the difference. Again, please take note. REITs, yes, can have capital gain, but in terms of the numbers, okay, REITs can definitely not beat stocks. Okay, so REITs for me is for passive income, and I actually use ETF as a diversification tool. Because most of my money is actually in Singapore, so that's why I actually use ETF to help me invest overseas. So this is how I have my portfolio. Okay, everything I buy, that is a very good reason. It's not just about more money, no. Okay, it's about either this actually for protection, is it for wealth accumulation, is it for passive income, or is it for diversification? Also, REITs for me is for passive income. Okay. So what is a REIT? Vehicle structured for investors pool their capital investment to large-scale income producing properties. Trust structure complies with regulation for tax efficiency. So derive profit from rental income, hence it's a dividend play instrument. So hopefully it's clear why and when should you actually use REITs. Only when you actually need to generate passive income. So let's say, for example, you are the younger folks. Okay, maybe REITs, you may not just want to buy a lot. I'm thinking if let's say I'm still in my 20s, probably I only use like 10% of my money in REITs. I just want to start the tap, that's all. Okay, easily, let's say if I'm in my 20s, easily, 60-70% in more of the higher risk instrument like stocks or ETF. Okay, but as I age, okay, probably my REITs percentage will increase. So as I mentioned just now, I believe on the day I retire, easily 70% of my money in REITs, okay, because it can actually give me a very steady passive income. So hope you all have a clear understanding when and how you should deploy and use different instruments. Okay, so again, if there's any questions, feel free to just pop it up into the chat. I will answer as I can. Okay. Now, I want to give you an overview of the REITs market. Can anybody make a guess how many REITs do we have listed in the stock market today? Can I get you all to make a guess just for fun? Then you all can remember the numbers better. If I just tell you, you'll forget very quickly. How many REITs? 30 more than 30. More than 30. 41 too many. So between 30 to 41. Between 30 to 40, between 35 to 41. Between 38 to 41. Between 38 to 41. 39, congratulations. Okay, I believe after this exercise, you all can remember the number better. Okay, so 39 REITs for you to choose from. Okay, 39 REITs. So, okay, so this I believe all the REITs are actually stated here. Now, so how do we actually categorize them so that it's easier for you to choose? Number one, okay, we have to know who is their sponsor. Okay, what is a sponsor? Sponsor is basically the entity that form the REITs. Okay, like for example, CapitaLand is obviously a sponsor. Fraser is a sponsor. Okay, Mapletree is a sponsor. So from the sponsor, usually from the sponsors, we can, okay, this is an informal classification. There's no official classification. We will actually classify what we call a grade A or grade B REITs. Okay, grade A or grade B REITs. So what are grade A REITs? So grade A REITs, generally speaking, I will actually affectionately call them Akong related REITs. Anybody want to guess who is our Akong? What is Akong related REITs? Anybody want to make a guess? Who is Akong? Thank you so much, government. Thank you so much. Okay, so Akong related REITs, okay, either government or Temasek. So we are talking about who are they? So we are talking about Ascenders. Okay, Ascenders, Escort. Okay, number 2. CapitaLand. Okay, number 3. Keppel, number 4, and Mapletree, number 5. Okay, so this is what we call Akong related REITs. So if you actually go and trace, all of them have parentage linking either to Temasek or government. Okay, again, what are the 5 are? Ascenders, Escort, CapitaLand, okay, Keppel, and Mapletree. So these are the 5. So like I said, this is unofficial classification. So there are people who say that, okay, well, actually more stringent, that means Akong related REITs with most of the properties in Singapore, then they actually consider grade A. So like for example, CapitaLand Retail China Trust, they don't consider grade A because their properties are in China. Okay, then like for example, Mapletree North Asia Trust, same thing, okay, is also not considered grade A because the properties are in China, Hong Kong. Okay, so same for Keppel Pacific Oak. So if you really want to be very precise, okay, so what are grade A REITs? Akong related, and most of the properties are in Singapore. Okay, so why do we actually have this classification? So generally speaking, so these are the what we call safer REITs. Okay, safer REITs. So number 1, safer. Why safer? Because number 1, they are all related to Akong. That's one. Okay, number 2, if you actually look at all these REITs, most of them, Temasek is the major shareholder. So in that sense, there is a better stability in the prices. So far, of course, it has happened before, but not for REITs. You seldom see like, well, Temasek suddenly sell 10% of the REITs away. You don't have that kind of situation. So there is quite a strong backing there. Okay, and of course, a lot of the properties under this is also of better quality properties. Okay, so being government related, obviously, you know, they have first right to a lot of very nice properties. So these are the reason why it's called grade A. But what is one of the downside for investing in a grade A REITs? What is one bad thing about investing in grade A REITs? Anybody can share? controlled growth. Not really. No, no. They are also very. Thank you so much. Life is very fair. So higher risk, higher return, lower risk, lower return. So in fact, all these grade A REITs, we are looking at the range of their dividend probably around 4 to 5% right now, 4 to 5%. Okay, so life is very fair. You know, you want something safe, you want something good, then you must make do with you know, lesser returns, lesser yield. And of course, if you actually can take higher risks, then can get better return. Okay. Now, I want to be very clear here. Doesn't mean that the grade B REITs are no good. Okay. So it doesn't mean that grade B REITs are no good. So grade B REITs, some of them can also be very good. Okay. So like, for example, Fraser, I'm quite sure you know Fraser is a very prominent brand as well. Well, you have CDL. CDL is a very prominent brand as well. Okay. And of course, things like, for example, Far East. So again, it doesn't mean that, oh, grade B is no good. Okay. And it's just that grade A is better because it's alcohol related. And at the same time, in fact, what is most important is the property. It's the property. I always like to jokingly say, so if let's say, for example, you let me go and run, let me go and run CapitaLand Integrated Commercial Trust. I don't think I can, what do you call it, do much worse than the current CEO, put it that way. Okay, because a lot of the what do you call it, a lot of the income comes from the property. Okay, I'm not saying that the manager is totally useless, I don't get that, but you know, how the managers can value add relative to the property, so in fact it's actually quite limited. Or put it this way, for a REIT, what is most important is actually still the property, rather than who are the managers, is it you know, is it a star manager, whatever, so on and so forth. Okay, so these are the 39 REITs. Okay, sponsor is very important. So far, still no questions. Anybody, any questions so far? All good. Okay, no questions, then I push on. Now, how do we actually classify the REITs? Besides the sponsor, the other thing is actually what I call the property types. So that's the other classification, property type. So we have office buildings. So you can see we have 10 of them. Industrial logistics, okay, 12. Retail malls, hospitality and hotels. Hospitality means hotels, and healthcare buildings. So these are the 5 different property types. Okay, 5 different property types. Okay, so for REITs, generally speaking, we are there for the long term. Okay, especially based on my strategy. Okay, I'm actually there for the long term. In fact, this is my wish. This is my wish. I hopefully that eventually I can even pass on my REITs portfolio to my daughter. Then the passive income can also continue. So from that perspective, right? The most important question when we actually want to choose a REIT is not so much about the dividend, not so much about leverage, but then the most important question you may ask is this: this property, 5 years later, 10 years later, can they continue to generate income? I think that's the most important question. Let me do a little survey to illustrate this point. Okay, now, I'm quite sure you all know about, because of COVID, a lot of companies are working from home now. Okay, so the question I have here is this: is this going to be a permanent feature or not? If let's say, for example, this work from home, you think that it's going to be a permanent feature after COVID, okay, we are not required to go back to the office. Okay, please help me type a 1. If you think that this work from home is going to be just a temporary feature, that means after COVID, okay, all the companies will get their staff go back to offices. Please help me type a 2. So just an opinion. Okay, 1.5. Thank you so much. Okay, we've got a few 1.5. Okay, great. Thank you so much. Also, these are the questions you need to ask. Of course, it's a tough answer, but then we have a choice. So my point here is this: if for those who actually think it's a one, then probably you have to ask yourself, should you actually invest in office REITs right now? Or either that when you invest, you may actually want to be a bit more careful. Okay. And of course, for those who actually type a two, then probably today may be a good time to look at office REITs because the price of office REITs has came down. It has recovered, yes, but have not gone back to the pre-COVID level. So it can actually be quite interesting. Okay. So frankly, I also don't have an answer. Okay, I will share my opinion. Okay, but I don't have an answer. But my point here is this is how you should analyze REITs. So this is the most important question to answer. Rather than just looking at dividend yield, rather than gearing ratio, yes, they're also important. But the most important question to answer is this. Okay, this property, 5 years later, 10 years later, do you believe that they can continue to generate rental? That is the most important question. Okay, so let me just share with you my opinion. I will key in two. Personally, I will key in two. So in fact, now I am actually quite bullish on office REITs. Okay, I'm not sure whether you all notice. Let's see whether I can find an article. Okay, there is actually a few articles. So maybe I can give me 1 minute. See whether I can get. Okay, by the way, I am I'm actually helping SGX to do REIT seminar for China clients. So maybe one day they will actually come. Okay, yeah. So this is the one I actually want to show. Okay, so a lot of people thought that now the vacancy rate for offices is quite high. So that is not true, at least based on this article. So net demand for CBD Grade A office turned positive in first half. This is first half of 2021. Okay, what do you mean by net demand? That means the number of companies going in is more than the companies going out. That is what is happening, at least in first half of CBD Grade A offices. Okay, why is that so? So, okay, sorry, I did all this in Chinese. Let me just translate. So basically, a lot of Chinese companies, okay, Chinese company, a lot of them are actually thinking of expanding their business overseas. And as you know, expanding a business overseas, China may not be the best place to put their headquarters. Okay, either for tax reason or for political reason, China may not be the best place. So in fact, a lot of all these Chinese companies who has the desire to do overseas business, they are actually setting their overseas HQ in Singapore. So iQIYI, anybody know what does iQIYI do? Maybe you can share iQIYI. Anybody know what does iQIYI do?
Yes, they are like Chinese Netflix.
Thank you so much. So they actually set up here. Then 字节跳动 is actually ByteDance. So ByteDance is TikTok. Okay, so as per this article, okay, sorry, I don't have the English version. Okay, ByteDance, okay, they already have is in Singapore. So apparently they actually rented somewhere whereby the monthly rental is about 80,000 Sing. Okay, then of course you have Donghai. Okay, the Donghai Ant Group. Okay, so they just won a license for the digital license. Then obviously they're actually going to run some office here. So you can actually expect a lot of Chinese company. So apparently, at least based on this article, there's more to come. More Chinese company to come. So yes, Erwin, yep, the geography of CBD is also changing quite dramatically. Yeah, so one day, I don't know whether it's good or not, or maybe you see more Chinese companies in Singapore. Okay,
No. What I meant is that what you define as CBD, right, is changing. So which buildings and where they are sited is is important, right? Within the CBD, I mean, like things have moved from a lot from Shenton Way moved to Marina Bay Financial Center, and things are moving to Jurong and stuff like that.
So I think when they mention, are you referring to this article?
Yeah. So I'm trying to figure out, like when you make investments and you're looking at properties, where which properties to look at now, because I think the nature of the CBD is also changing.
Okay. At least for this article, so of course I don't have the full. Okay, what they mentioned is really Raffles Place, including Suntec, including Marina Bay, not Jurong. At least based on this article. Yeah, so hopefully that answer your question. Yeah. Okay. Let me just go back to my initial deck. So that's why I'm actually still bullish on office. Okay, now another thing you have to take note here is this. In fact, before I express my point, now make a guess. If let's say, for example, you want to buy a REIT which only has Singapore properties, make a guess how many of the REITs can you choose from? Or put it this way, how many REITs are out of 39 only have Singapore properties? Can I just get someone to make a guess? 10, lesser. 5, congrats, there's actually only 5. Okay, if not, most of the REITs, they either have a mixture, that means Singapore properties and overseas properties, or either that they only have overseas properties. Okay, so my point here is this, so please don't assume the world is like Singapore, which is not true. If you want to buy REITs, very likely you will be buying REITs that has overseas properties. So please make sure you know what you are getting at. That's my point here. Like for example, Elite. Anybody invested in Elite? Okay. Elite commercial REITs. Okay. Let's look at Elite now, for example. So it's always good to actually look at the picture of the property before you invest. Okay, let's say look at our portfolio. Okay, so like for example, Elite REIT, okay, you look at the property. Just by this look, how do you feel? Okay, how old do you think this property is? Is this old or new property? Do you, just by the look at it, does it look old or new to you? Okay, thank you so much. So again, please don't assume that, this is office REIT, by the way. Okay, please don't assume that all the REITs you are talking about the tall, swanky type. Okay, it can be like this. Again, I'm not saying this is bad, but I'm just saying that please don't assume. Okay, don't assume that every of the property is your CBD type of property. No. Okay, don't assume. Okay, but don't get me wrong, I'm not saying it's bad. It's just that when you actually want to buy this, so please know what you are getting at. So a lot of them, yes, are freehold properties. But if I'm not wrong, some is actually older than my mom, if I'm not wrong. Okay, so you can roughly know how old they are. Okay, so of course, is it good or no good? I stop it there before I get into trouble. Okay. So there is basically a lot, like for example, this is UK, this is Germany, capital Singapore and Japan. Capital price, of course, this is US. Okay, this one, Singapore, yes. Okay, this one is Hong Kong, China, US, Singapore, US, so Suntec is predominant in Singapore. So my point here is this, please at least go and look at the photo, especially those with overseas one, know what you're getting at. Okay, now industrial. Industrial properties. So down here, we all classify them together because they have the same land title, but there are actually 4 very different type of users. So you have industrial, you have logistics. Hopefully it's clear. So basically industrial is your factories. Logistic is your warehouse. Okay. Then you have business parks. Okay, business parks are basically offices sitting on industrial land. Okay. So can I just get someone to name what are some of the business parks in Singapore? Maybe just for share. What are some of the business parks in Singapore? Can I just trouble someone to type in the chat? Okay, thank you so much. International Business Park. Changi Business Park. Okay, thank you so much. So basically you are looking at officers sitting on industrial land. Okay, Science Park. Thank you so much. Okay. Then of course you have data center REITs. So this is our incoming. So Keppel is the only pure data center REIT. So that means all their properties data center. A lot of other REITs, they are also going to data centers. Ascendus is also going into it. Maple Tree Industrial is also going to it. So just to take note, there's actually quite a number of REITs going into data center. Okay. Now, for industrial, okay, something to take note of. Can I just get someone? Okay, so number one, I just want to talk about the concept of land tenure. Okay, for HDB, what is the land tenure for HDB? Can I just get someone to share, please? Land tenure for HDB. 99, yeah. So after 99 years, what's going to happen? Do you actually get any money back now? So after 99 years, the government will take back the HDB from you. Do you actually get any money back? After no, thank you so much. So please take note. I got this friend. He is YOLO, YOLO. To go and buy the Tiong Bahru walk-up apartment. Then I say good luck to him. So that one, I think only left about 40 or 50 years. So by the time he's 70 years old, don't know what's going to happen. So anyway, for industrial, does anybody know for industrial land in Singapore, what is the land tenure? Industrial land in Singapore, what's the land tenure? Okay, it's actually between 30 to 60 years. So the newer ones will be 30 years. Some of the older ones are 60 years. Okay, so something to take note of, if let's say, for example, you buy an industrial REITs, their properties are in Singapore. Okay, a lot of them, their land tenure is only like about 30 years. Okay, so now on average speaking, it's only about 30 years. Okay, that means 30 years later, of course, the government will take the land back, the building back, and that's it. Then your dividend will also stop. So that is something you have to consider when you actually invest in industrial REITs. So what are some of the REITs doing right now? What I can see is they are actually diversifying into other countries. So this 30-year rule is only for Singapore. Now, if let's say talk about Malaysia, can anyone please share? Usually in Malaysia, their land tenure, how long is it? What is the land tenure for Malaysia? Anybody can guess or share? Malaysia. What is the land tenure? Anyone can make a guess? How long is the land tenure? Okay, thank you so much. It's actually freehold. Thank you so much. Okay, so Japan, Australia, Europe, US, so a lot of their land is all freehold land. So that's the good thing about big countries. Okay, Japan, Australia, Europe, US, a lot of land actually freehold. Okay, now China commercial land, what is the land tenure? China commercial land, what is the land tenure?
You mean?
Yes.
Even if the land is freehold, the building also gets old, and then what will happen to it?
They have to maintain. Usually building can last one.
All right, so that means it can As long as can last, it will still be there lah.
Correct. Yeah.
Oh, okay. Thanks.
Usually building can last lah. It's it's the land. Yeah. Yeah. So for China it's 40 years. 40 years. So these are certain things you want to think. Like for example, I give you an example why I currently it's actually very difficult for me to buy Maple Tree Industrial Trust. Okay, let's look at Maple Tree Industrial Trust. Let's see what is the yield right now. It is a bit hard for me to. Okay, it's a good REIT lah. It has a very good property. It's Akong rated. It's grade A. But let's look at what is the yield right now. Okay, you can see that the yield is 4%. And most of their properties are actually in Singapore. Okay, you can take a look. Most of the properties are actually in Singapore. Okay, so you can see most of them is actually in Singapore. And if you click into it, let's see if they show it here. Okay, they doesn't. Okay. So if you go to the annual report, they'll tell you. So a lot of this property left 20, 30 years. Now, let's assume it's 30 years. So if I get 4% yield, I get for 30 years. That means in total, 4% times 30, I get 120%. Okay. And actually, I don't earn much. You all know what I'm trying to get at. So let's say, for example, I invest today for $1. Every year I get 4 cents. So by the time after 30 years later, I get back 120. So I put $1, I get back 120 after 30 years. Not very exciting. Also, that is something you also have to take note of. And unfortunately, actually, I quite like the property, but so low, how do I actually buy? Okay, so land tenure, something for to take note of. Okay, so just in case, so for commercial property in Singapore, like offices and retail malls, it's also 99 years. It's only industrial is 30 years. So just for information. Okay, so we have retail malls, again, same thing. Please take note. This is again another good example. So of course, for those who believe that eventually, nobody will go shopping mall anymore, everybody will buy things online, then of course you may want to be careful on retail malls. If not, again, I think now it's actually quite interesting. Look at it. The prices are also quite depressed. Personally, I still like retail malls. Frankly, we talk about e-commerce for so long, but if you actually go to all those grade A malls, like for example, those under CapitaLand 1, or either that goes under Fraser Center Point 1. So next time you go, maybe try to take a look. Very seldom you see empty shop lot. Yeah, I'm quite sure you'll agree with me. Like if you actually go to, I don't know, Junction 8, Tampines Mall, okay, very seldom you see empty shop lot. Okay, like Fraser's only recently, Fraser's, if you actually go to Changi City Point, okay, by the way, Changi City Point is under Fraser's. Theirs is also not because of e-commerce. Theirs is because they have quite a few traveling shop, like Samsonite, okay, sell winter wear one. This one is of course badly hit by COVID. If not, the rest of the shop actually still quite okay. So I am still a believer of retail malls. I'm still investing in it. Of course, this is very personal. Nobody knows what's going to happen. Okay, if you think that, well, next time because of e-commerce, nobody shop anymore, then of course don't touch. So in fact, quite interesting, like Paragon. Everybody said that, wow, Paragon very empty, nobody go and shop. But recently, or at least this year, I went to Paragon twice. I don't really see empty shops on there. Okay, so something for the take note. We have hotels. Of course, this is the one that is worst right now. Worst hit by COVID. Okay. Eventually, I will invest in them lah. Okay, I am very bullish on hotel properties. So in fact, personally, out of the 5 categories, I think the hotel demand for hotel will have the highest growth. Will have the highest growth potential. If you ask me, okay, based on the fact that people will actually travel a lot more. People will travel a lot more. Also, I think hotels will have the highest demand growth. Of course, this period is bad. I am not investing in hotel REITs yet. I'm still waiting for the right timing. There are actually some reports, if you actually go and Google online, they said that only up to 2024, then hotel industry will be back to pre-COVID level. Also, of course, it's up to you to whether you agree with that report, but apparently it's actually up to 2024. Okay. But if let's say, for example, you want to buy something cheap, now hotel REITs are still very cheap compared to pre-COVID level. Okay, and lastly, we have healthcare buildings. The most prominent one is Parkway Life REIT. So you will actually own Gleneagles Hospital Building. You will actually own Mount E Hospital Building. Then you just rent to the hospital. You don't own the hospitals. You just own the building, rent to the hospitals. So First REITs, they actually own hospital buildings in Jakarta. So apparently, they were saying that the hospital brand is equivalent to Mount E. So this is what we're buying. Oh, by the way, for Indonesian REITs, okay, First REITs and Lipo Mall. Okay, so the land tenure for some of the properties are actually very short, 8 to 10 years. Okay, so again, something for the take note. So Lipo Mall, First REIT, land tenure are very short. So apparently, there was I actually had this chance to speak to their fund manager way back. So of course, I asked them the same question. So land tenure so short, what's going to happen when the land tenure expire? So don't ask me which REIT. So one of the REIT, the fund manager just tell me they just have to pay admin fee, few $1,000s can extend. Okay, one particular REIT, that's what the fund manager tell me. Okay, for another REIT, this fund manager tell me also can extend, but how much to pay, it depends on the governor at that point in time. Okay, so these are some of the risks you have to take note of if you actually invest in Indonesian REITs. So the land tenure can be very short. Then obviously, once the land tenure is up, the government has the right to actually take it back. Okay, so these are the overview of the 39 REITs. Anybody has any questions about it? Okay, so why I actually go through in such detail is because, as I said, the most important question for REITs is this: you must be in the opinion that 5 years later, 10 years later, the REITs, the property are still good, can generate income. So don't just blindly buy because the name sounds nice, because now the yield is good, so on and so forth. No, so please at least look at the properties. Okay. So this, I think I have actually shared some way you actually can find more information. Maybe I just run through them very quickly. Okay, so number one is the stock screener. Of course, later we'll actually look at it a bit more. So how I come here, SGX stock screener. Okay, securities, price screener, stock screener. Okay, just key in any REIT now. So let's say CapitaLand. Okay. So you can see that the price is like this. And of course, you can get a valuation here, so on and so forth. Okay. Then if you want to find out more about the properties, you can go to the website. So all the REITs, they will have a website. So you should look at what are the properties. Okay. Another website that I use very often is actually this thing called reitdata.com. Okay, of course, I will talk about it a bit more later. Okay, whereby you can actually find the dividend yield for the REIT. Okay, if you're back, don't mind just suddenly type a 1 onto the chat, so that I know that you're back. Thank you. Thank you, Stella. Thank you, Sammy. Edison, thank you. Thank you. If you're back, please help me just type a 1. Okay, great, great. Thank you. Thank you so much. Okay. So once again, what we are going to do for the next maybe 15-20 minutes, I just want to give you a step-by-step guide into how I choose my REITs for that particular month. Okay, so probably it's a bit easier. I put it in a very process format. So now, number one, this is what happened here. Okay, I have allocated $2,000 per month, okay, to invest in REITs. Okay, and I this rule whereby every REIT I buy is $1,000. Okay, $1,000. So that means maximum per month is I'll buy 2 REITs. I'll just buy 2 REITs. Okay, so there are times whereby I cannot find 2, I'll just buy 1. Okay, and there are times whereby I cannot find any, so I buy 0 for that month. Okay, so the key thing I want to stress here is this: turn it into a process, so that you will just very easily just go and apply this process. Don't have to think too much. Every month, just spend maybe like 20-30 minutes, just go through this process. Can find any REITs or not? Can find buy 1 or 2, cannot buy 0. Then the key thing here is you keep continuing the process to build the portfolio. Okay, so in fact, that is more important. I rather than the first time you do very careful or do very well, then after you do for first time, subsequent month do nothing. Okay, hope you get what I'm trying to get at. So what is more important is that continuity. Okay, I rather that you first time you do it or you make mistake, you don't do it well. Okay, but you continue to do so such that your portfolio. Okay, so once again, what do? I allocate 2,000 per month. Every time I buy REIT is $1,000 per REIT. So maximum I buy is 2. Sometimes I buy 1, sometimes I buy 0 if I can't find anything. So now how do I actually select that 1 or 2? So these are the 4 main questions. Is it 4? Yeah, 4 main questions I ask. Okay, is the dividend yield higher than the fair yield? Okay, that's 1. Number 2, does the dividend has growth potential, which is basically looking at the properties. So basically, I must be in opinion that the properties must be good. Okay, and thirdly, okay, in fact, these 2 is the same. So what is the risk? Also down here, I'm very focused on credit risk. Okay, so just to help you remember, so in fact, every month I just look at 3 things: the dividend yield, the property, the credit risk. And this will help me to select that 1 or 2 REITs. Okay. Now, dividend yield, where do you get it? So one place is reitdata.com. Just now I reshared with you. Then the other place is, of course, SJAC Stock Screener. Okay, you can look at this dividend. Now, this is only for this period of time. Okay, this is only for this period of time. So what happened here is this, be it reitdata.com or this one, okay, SGX, they actually use history as a reference. Okay, so as you all know, for the past 1 year, the rental has been very bad. So I think looking at the yield rental for past 1 year is actually not fair. Okay, so for this period, how I actually calculate the current yield. This is what I do. Okay, only for this period. Okay, most of other times, okay, I can simply refer to either read data, okay, which is here, get the dividend yield, or I can look at the SGX stock screener. Okay, this period I can't because especially for the first 6 months or past 1 year, okay, the rental is very low. So I don't think it's fair for the REITs. So only for this period, this is what I do. So let's say Capital.com, or okay, since I got Maple3, okay, I just go to investor relations. Okay, I look under financial information. Okay, then I look at the presentation slides. Okay, so down here they have, okay, you can see that first quarter. Oh, this is the quarter one. Sorry, I want to look at the first quarter. Okay, I want to look at the fourth quarter one. Okay, presentation slides. You can see the distribution. So this is fourth quarter. They go by, they have the yearly one. Okay, here 12.55, you can see here 12.55. And this is Maple3 Industrial, right? Maple3 Industrial. Then I go to the stock screener, look for the stock, I look for the REIT. 272. So I just do a simple calculation. I take 12.55 divide by 2.72. Okay, so this is the dividend I use, 4.6%, rather than what is actually on the screen. Now you put 4.05, so I will actually use 4.6%. Okay, okay, 4.6%. So let me just use CapitaLand and do a demo again. So just in case that one is a bit too fast. Okay, so this is what I do. Let's say I go to CapitaLand. Okay, CapitaLand Integrated Commercial Trust. Okay, investor relations, financials, financial results. Then I look for the presentation slides. Okay, you can see the first half DPU is 5.18 cents. So what I do here is this. I will take this. Okay, 0.0518 times 2. Okay, that is 10.36. Then I look at the price, 2.06. Divide by 2.06. Okay, so it's actually 5%. I will use the current year as 5% rather than what is shared here. So down here they actually put 4.4. So to me it's actually 5%. Is everybody okay? Anybody want me to repeat the calculation? If so, just type a yes. I'll repeat. If not, I'll take it that you know how I get my numbers. Anybody want me to repeat?
Oh, sorry, Imin, just now you times 2 because that one is a half yearly dividend, right? So if it's a quarterly, then we just times 4.
Correct. That's right. Yes. Yes. Okay. So like I said, only for this period, I actually do this. Then it's actually more accurate. Usually, minus away COVID, I just look at either read data or the stock screener is actually good enough. So like you can see there's this discrepancy. Like for example, CapitaLand I calculate about 5%, but for the stock screener is only 4.4. Then the REIT data, if I look at REIT data, they still quite Capital Mall Trust is 5.29. So it's like there is certain disparity. So this period I do this to actually get my numbers. Okay, so number one, get the dividend yield. Okay, find your dividend yield. Now, I actually have this list called the fair dividend yield. How I actually get this fair dividend yield is I basically take the average dividend yield of the REITs in the same sector. Okay, how do I get this 6%? So what happened here is this, we have retail REITs, we have about 10 retail REITs, right? So I actually go and find the 3-year dividend yield for each retail REIT. Then I average again for all the 10 retail REITs to actually get this 6%. So I simply just use a benchmark to compare. Okay, so a lot of people say that this method is very simple, but it works well for me. So of course, if you insist of doing like, what do you call that, discounted cash flow, blah, 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 sure, go ahead. But I think this method for me to build a portfolio is easy enough, okay, and it encourages me to keep continuing. I think that's the main point here, rather than something so precise, so complicated that you're too lazy to do, then end up you don't build a portfolio. Okay, so by the way, I've updated the numbers, so I just want to update here. So for office now I also use 6%, and for industrial I actually using 6.5%. Okay, so this is how I get the fair yield. Now, there is one other rule, okay, for the REITs that I like, or for the REITs that I like the property. Vivian, sorry, which part you want me to repeat? Sorry. Okay, the retail, okay. How I get this 6%? So number one, this is what I do. So if you look at retail REITs, there are 10 retail REITs. So I go and find the average dividend yield for each REIT over the past 3 years. Okay, average dividend yield of the REITs, each REIT over the past 3 years. Then after that, I average it out again to actually get that 6%. Ming Feng question, how will the value change over time? So of course, if let's say, okay, because what happened over the recent years, the yield get lower and lower. So like, for example, previously when I was doing this, I'm actually looking numbers from 2019, 2018, and 2017. Okay, so the current one, which I just changed, I'm actually using numbers from 2020, 2019, 2018. And 2020, okay, the yield is actually lower. So that's why the expectation is also lower. So Ming Fong, hope I answer your question. Okay, good, thank you so much. Okay, now there's additional rule for the REITs that I like. Okay, I will minus 1% from the fair yield. Okay, so like for example, Akong REITs. So basically I like all the Akong REITs. So let's say for example, CapitaLand Integrated is Akong REIT. Then the fair yield will be 5%. How I get 5%? 6 minus 1%. Okay, for the REITs that I don't like so much, I will stick to this yield. Okay, so maybe I just give an example, then it's clearly clear. So let's say, for example, just now we look at CapitaLand Integrated Commercial Trust. The yield is now let's say 5.1%. The yield is now 5.1% for Capital Integrated Commercial Trust. So assuming that I like the REIT, I like the property, okay, is the current yield of 5.1% above the fair yield or below the fair yield? above or below? Okay, one below, one above the rest. Okay, here's the question. So just now we checked Capital Integrated Commercial Trust. The yield is 5.1%. Okay, it's a retail rate. It's a retail rate. So assuming that I like this rate, so this 5.1%, is it above the fair yield or is it below the fair yield? Okay, it's above the fair yield. Okay, because if I like, then my fair yield, I just minus 1. Okay, I just minus 1. Okay, so to me, actually now the yield is quite attractive. So just to be clear, okay, maybe this one just to help you be clear. So for dividend yield, higher better or lower better for dividend yield? Higher better or lower better? You prefer higher better or lower better for dividend yield? Okay, thank you so much. So now it's actually giving 5.1. Okay, I need it to give me at least 5%. So to me, I actually find the price of CapitaLand Integrated Commercial Trust, I think is actually quite attractive right now. So that is how I use this chart. Okay. Okay, we just now also checked that Mapletree Industrial Trust, the yield is 4.6%. Okay, just now the yield is 4.6%. Assuming I like the properties, assuming I like the properties, okay, based on 4.6%, is the price attractive now? Yes or no? Okay, no. Why? Because I use industrial 6.5, even I like it, value is 5.5, and now it's 4.6%. So no, I don't find that really attractive. So that's why it's a bit hard for me to buy that REIT right now, even though I don't know why the price keep going up.
Sorry, you mean?
Yes.
So
yeah.
this is the way you find that whether the price is a fair price for you to buy.
Correct. Yes.
Oh, okay.
Yes,
yeah.
I look at dividend yield instead. Yeah.
Thanks.
So I thank you. Thanks for bringing it on. So basically, I don't look at the price. I use the yield. I use the yield. So this is how I see whether the yield is attractive or not. Okay. Any questions on this? Anybody? Any other questions? So this is in fact the most important part. So with this, I have helped me to filter down a lot of REITs. So again, like for example, the REITs I like. Okay. I minus 1. Basically, all the grade B REITs, I will just stick to this number. I wouldn't minus. Okay, the grade B1, I will just stick to this number. Okay.
I'm sorry, Emin, I still don't understand. How come for the REITs that you want, you were minus 1% from it? Is it because you want it, that's why you are willing to get it for a slightly lower percentage?
Correct. Yes.
Oh, okay.
We have to be, how should I put it? Because you know, good REITs, everybody also want. We have to be realistic. So it's very hard to get good REITs at a very cheap price. So if we want a good REITs, then we must be willing to pay higher price.
Okay, thank you.
Yeah. Okay. Good. Thanks for the questions.
Sorry.
Yes.
Does it mean that this fair yield you have to do it yearly?
It will change.
Yeah, it will change.
Yes.
But let's say at the end of the year, beginning of the year, I'm going to redo this fair yield for the last 3 years.
Yes.
So do you do it that way, or every 3 years then you do it once?
No, I will do it every year. I'll do it every year. Okay, but so far it hasn't really changed very much. Then of course, all you have to do is you just drop me an email, then I'll just send to you. Yeah, when you know, every year when I change, or usually when I update, I'll let you all know.
Yeah, that'll be a great idea.
But so far it hasn't changed really very much. Yeah, it doesn't change very much. Okay. So from here, this is my first step. From 39, it's sort of like, you know, string down, filter out quite a number of REITs already. Okay. So the number two is of course looking at the property type. So basically, okay, this one is the most important. I'll ask, okay, whether this property going forward, would I believe that 5 years later, 10 years later, can they continue to give good rental? So that's the most important. And as much as you can, we try to understand all the properties a bit more. Okay, life is very fair. The more you try to understand, the better. So we look at the location, the age, land title, lease profile, so and so forth. So let's say, you know, we talk about this. So if you think that Orchard Road, all the malls are dying, then better don't touch, so and so forth. Property specifics like location, okay, if this property is not in Singapore, okay, in the outskirts, are you okay with it or not? Okay. Then the age and quality. And of course, the land title expiry that we talk about it. Okay. For occupancy, right? For occupancy, so to me must be more than at least 90%. Okay, must be at least 90%. Later I'll share with you how to find this number. Okay, of course, where to get this information. Now I just want to give you, okay, there are certain REITs I will not touch on. So based on this, okay, based on all these factors, demand and supply, location, age, there are certain REITs I wouldn't touch. Again, this is personal. I'm not speaking ill of the REITs. This is personal. I just want to give you a sense of how I choose. So let's say, for example, okay, so just now we talk about Elite. Okay, personally, I'm not a fan of it. Okay, why? To me, I think the properties also look a bit old. And if you actually take a look at the location, it's not really in the CBD area. So of course, the rental is actually still quite good. Okay, so part of the reason why I don't like it is also because I'm not familiar. Okay, so even if, let's say, for example, the yield they actually pass is higher than the fair yield. So let's say even for Elite, let's see what's Elite now. Okay, let's see. Elite, do they have it here? Okay, the U now is 7.5. Can you see 7.5? So this is an office REIT. So obviously it actually passed. Okay, the U is actually considered very attractive, but I will not touch it because I am personally not confident of the property. Again, this is very subjective. Of course, someone who are more familiar with UK, seen those property before, probably you have better confidence. But for me, because of my lack of knowledge, so I will not touch. So that's why it's actually good to go through after, and the good thing is you just need to go through this exercise this one time, because the properties don't change very much. The portfolio property won't change very much. So in fact, for me, I think I only have about 25 REITs out of 39. Probably there's only about 25 I will choose. Don't ask me which are the 15 I will not touch before I get into trouble. Okay, but then like I said, it's a lot based on personal preference. And how I choose this 25 is really based on these few factors. Okay, do I think that 5 years later, 10 years later, can they continue to rent it out? Okay, so the location, am I okay with the location? Are they too old? Okay, the land title, is there something of my worry? Okay, and of course the occupancy. So that is the second step. So again, you know, you can tell me like a filtering process. From the dividend, I filter down already. Then after that, let's say maybe dividend 39, I cut down to maybe 30. Then after that, minus off the REITs, the property I don't like one, then maybe it comes 15. So can you see that process? So basically it's a filtering process. I do it month after month. Okay. Okay, hold on for this occupancy first. Later I'll share with you where I can get this figure. Then the last test is actually the loan related risk. So the main test to look at is this thing called the gearing ratio. I want it to be less than 40%. Less than 40%. This is the main ratio. So where do I actually get this ratio? Where do I actually get this ratio and the occupancy ratio? Okay, you can actually look at it from the the presentation slides again. So let me just go back. Okay, like for example, this is the Maple Tree one. Okay, they will always share with you their gearing ratio. Have to find a bit though. Okay, so down here, can you see 40.3? So again, this one is a bit higher than my expectation. I want this number to be less than 40%. And the other ratio I actually look at is actually this thing called interest cover ratio. Okay, interest cover ratio. I want this to be more than 3 times. Okay, so these are the two ratios that I want it to pass before I buy. One is, okay, this one is actually below 40. Okay. The other one is, this one is above 3. Okay, let's look at the CapitaLand one. CapitaLand one. Okay, so you see, this one also a bit high for me. I want this to be below 40. Okay, interest cover, this one will pass, but this one I want it to be above 40. Okay. To find the occupancy, also this document you can find, I think is the front page. So you can see 95%. So to pass this test, to me, it must be more than 90%. Okay, as long as more than 90, it passes. So obviously this one pass. Let's look at the Maple Tree one. See whether I can find this one. Occupancy. Okay, so you can see the occupancy rate is actually above 90, 93.7. So you will actually pass. Okay, so these are all the steps I do every month. So once again, I actually summarize it in a chart, then it's actually easier for you to see. Okay, this is what I do. Number one, I actually scope up all the REITs above the benchmark yield. So I go and check what is the current yield. Usually it's actually very simple. Usually, what I do is I go to reitdata.com. So one shot can see all the yield already. Okay, then my fair yield is either 5%, 6%. So it's actually very easy to compare. It's only this period a bit troublesome. I have to go into the presentation to confirm this number is correct. If not, most of the time this number tend to be under report. Okay, like for example, okay, some of the numbers were actually a bit too low. Okay, you can see there's a lot of low numbers. So I don't know whether is it accurate. So I will actually do that check just now. So down here, from here above benchmark yield, I will actually filter out. Okay, then next I look at the property. Do I like the property or not? Is it too old? Is the location okay? Is the occupancy above 90%? Then is there an issue with the land title, the land tenure or not? So these are the few things. Okay, string down. Then lastly is that two ratios. The two ratios. Okay, Is the gearing ratio less than 40%, interest cover more than 3? So all these 39 REITs every month I will just put through this this process, this 3-step. That's it. Okay. Then whatever that pass will actually be in this potential purchase list. So if there's more than 2, then I'll just buy my 2 favorites. Okay. If there's only 1, I'll then just buy 1. Yes, indeed, there are certain point in time whereby, you know, I cannot find anything. Then that month I won't be buying. No? So I actually just repeat this process month after month after month. And that is how I actually accumulated this portfolio. Okay, that's how I over time accumulated this portfolio of REITs. Okay, and after that, you know, every quarter, okay, I will actually get this kind of dividends to actually have my passive income. And to me, this is the main point. Okay, it's not about whether I buy REITs cheap or expensive, or how to buy REITs at the lowest price. No, it's to build that portfolio. Is having that process in your investment system that actually matters the most. So yes, the numbers are not fantastic, but I started the tab, and I think this tab is just going to keep growing. And yep, okay, one day this one will cover my expenses, then I'll be financially free. So that is the whole idea for today's class. Okay, so to me, there's actually one more rule. Okay, I will only repeat buying the same REITs after I buy 5 other REITs. Okay, I repeat. So I will only repeat buying the same REIT after I buy 5 other REITs. So let's say, for example, this month I buy CapitaLand, CICT. I have to buy 5 other REITs first. Then I will repeat buying CICT. Okay, if there's no questions, okay, to summarize for REITs, hopefully, I hope that you can just remember this chart, this exercise flow chart. And if you can, every end of the month, just do this 3-step. Okay, what is the current yield compared with the fair yield? Scope up the REITs. Then for the REIT scope up, ask yourself, do you like the properties? Don't like the properties, throw out. Then do that 2 tests, pass, go to purchase list and buy 0, 1 or 2 REITs. And most importantly, every month repeat this process. Okay, in my case now, every month I'll spend either 0, 1,000, 2,000. Okay, every month repeat this process. Okay, what is more important is eventually you have that portfolio to give you that dividend income. That is the most important. So in fact now, if you ask me, like for example, this REIT, like a lot of all these REITs, at what price I buy at, I actually totally forget already. In fact, I'm not bothered. Okay. Well, what price did I buy? I actually, I'm not even sure I track. And if let's say, okay, do I still sell them? Yes. And why do I sell them? If let's say, for example, I think that the REITs is bad. I don't like the property anymore. Or let's say, for example, one day I change my opinion on retail. Then I just sell. I don't care what's my purchase price. Okay. So this is the attitude you should have when we talk about portfolio. So to me, it's not like, oh, wow, I think CapitaLand integrate lousy already. But now my price is below my purchase price. I have to wait. No lah. So if let's say one thing that CapitaLand integrated is lousy, I just sell. I don't care what's my purchase price. So that is the concept of building portfolio. Okay. So hopefully you all get the main G's. Okay, we are not trading REITs here. We're not buy low, sell high here. We just want to build this portfolio. As long as the property is good, I'll just keep it there. I just keep adding the REITs. I just keep focusing on the passive income. Okay, I don't care whether the price go up or come down. Okay, because if I buy every month, there'll be times I'll buy expensive, the price I buy cheap. Confirm one. Okay. But that is the process to get your portfolio up. Okay, if there's no other questions, okay, we are not done yet. I just want to spend the last 15 minutes to talk about real estate. So by the way, tomorrow I have invited my real estate partner to come and share about what is the latest real estate happening. So please come down. I think it's quite interesting. I actually look at some of the numbers, it's quite shocking. So just to give you a teaser for your information, Lentor. Okay, for those who don't know, it's Lentor. Lentor is quite, I think it's even to the north of Ang Mo Kio. Lentor is actually have a land sale recently. Okay. Make a guess, what is the likely launch price for the project there? Can I just get someone to make a guess? Lentor, okay, per square foot price for a condo in Lentor, which is between Ang Mo Kio and Yishun. Make a guess, 1,008, higher, 2,000, higher. Okay. Yeah, thank you so much. It's actually between 2.1 to 2.3. Okay, so based on the land bidding price, okay, so we can calculate that one. Okay, we actually is able to calculate. So based on land bidding price, you add in the construction price, then you add in the margin that developer wants. Yeah, it actually worked out to be between 2.1 to 2.3. So, and that is Lentor. Like I always joke, a place where bird also don't go there and lay egg. So now we're talking about 2001, 2003. So anyway, tomorrow I'll get him to come and share some numbers. It's going to be quite shocking. So hopefully you can come. Also for today's purpose, I just want to touch on some principle of real estate by just sharing you the case study. So of course, I have actually also done this in preview. Hopefully it's a refresher. Okay, what I actually want to illustrate here is this. There is a lot of, number one, real estate can be a very interesting investment vehicle. Okay, we shouldn't see real estate just a roof over our head. It can be a very interesting and creative investment vehicle. So I just want to use this case study to illustrate how, if you actually have an investment perspective to real estate, what are the different things you can do. Okay, and the other thing that I want to bring on this case study is actually for real estate, a lot of people thought there's actually only two ways to make money, okay, which is capital gain and rental yield. So in fact, there are two other ways real estate has helped a lot of people to get rich. So I just again want to illustrate with this case study. So what is this case study about? Mr. and Mrs. Tan. So let's say both working, monthly combined income 12,000. They have a 4-room HDB flat, Bukit Merah, 600,000 fully paid. So they need at least 1 million for retirement. They are worried that they cannot service mortgage, but they do deserve having a better lifestyle. Okay. So let's say, for example, if they upgrade, would it be too much for them financially? Let's look at the mathematics. So let's say they sell their HDB and go and buy a condo, 1.2 million, for example. Okay. So number one, this is something quite interesting. After they upgrade, they are actually more cash rich. Okay, assuming that all their money now is actually in HDB. So after they upgraded, they're actually more cash rich. So because you buy 1.2 million, you just need to put 12,000 down. They can actually release cash about $300,000. Okay. Of course, that is at the expense of taking a $900,000 loan. Okay. So current interest about 1%, 1.5. If they borrow 900,000 for 20 over years, it's about 4,000. Okay. So basically with their income, their mortgage payment is actually quite comfortable. But that's another thing. With a $12,000, they actually have a buffer for more than 6 years of payment. Okay. So again, what I want to try to say here is just try to change the perspective. A lot of people don't dare to upgrade is because they think, wow, I actually own a $900,000 loan. If I stay in my HDB, now almost loan free, very happy. But if I upgrade, 900,000 loan. So my point is this, if you actually look at it from an investment perspective, okay, with this $12,000 release, you have a buffer for more than 6 years of payment. Okay, so that's my point here. Instead of just focusing on the loan, you can see as a buffer. And 6 years is definitely long enough, quite long as a buffer payment. Right? So of course, I'm not saying what is right, what is wrong. We can argue that, hey, this is a bit higher risk. I don't deny that. Okay, but my point here is this. If you actually look at things from an investment perspective, it's actually not so bad, even if you take about loan, especially when you have a buffer. That's the main point I want to put across here. Now, okay, end of the day, as an investor, we must be risk conscious. Okay, let's look at the risk first. Okay, what if the worst case happen? After 5 years, they cannot service the loan anymore. They basically have to sell. So my point here is this. So let's say worst case, 5 years later, okay, assuming that both condo and HDB increase by 3%, the 600,000 HDB will become about 700,000, as you can see here. And condo, let's also assume that increase by 3%, 1.2 million property will become 1.4. Okay, so if they sell at 1.4, then after that, they pay off the remaining loan. So the loan is no longer 900,000. The loan actually becomes 760. Okay, so this is what I mean by having a forced saving mechanism. Basically, when we actually pay the mortgage, doesn't mean that every single cent go to the bank. In fact, we are saving money in our house by reducing the mortgage. Okay, and don't forget they have that 12,000. Assuming that use that 12,000 to actually pay the mortgage, they still have 82,000 cash left. So this is what happened. If let's say worst case 5 years later, they downgrade back 1.4 minus the loan plus the remaining cash, they have equivalent cash of 722. Okay, which means they can still downgrade back to HDB if they want to. So what I'm trying to do here is try to change the perspective. Don't be just so focused on 900,000, 900,000. If I cannot pay, I die. Or after 900,000, I could not quote my boss. I'm stuck to my job. Okay. The scenario I'm painting here is this. Number one, if let's say this is the case, there is a buffer. So even if you lose your job for a short while, won't die. That's one. Number two, worst case, downgrade back, still okay. Can afford downgrade back. Okay, of course, there are certain assumptions, but based on the logical numbers, it's possible. Okay, so again, this is what I mean by having an investment perspective toward a property. Now, but if let's say, for example, they can finish their mortgage, okay, so after 25 years, they retire at 65. So assuming a HDB increased by 3%, 600 become 1.2 million. Condo 1.2 become 2.5. So all they have to do is downgrade back to HDB. Okay, they will release 1.3 million, and that's it. They have actually accumulated their funds for retirement already. So how did this happen? Okay, because if they do an upgrade, they basically have built up what we call a forced saving mechanism. Every month they have to save this $4,000. So in fact, this is something that has actually helped a lot of people to get rich. Because once you have this payment, no matter what, you save this 4,000, don't have money, also try to squeeze the money. And because of that, if you can see, if they just put this through, okay, 25 years later, if they want to downgrade back, okay, they already have that wealth accumulated. So this is what I mean by really use property as an investment perspective towards property rather than just a roof of it. It's actually a very good wealth accumulation tool if you actually look at it from this perspective. Okay, that's not all. So you can be creative. So let's say with this $12,000, okay, with proper planning, they may not even need to top up cash to service their mortgage. So let's say this 12,000, they go and invest in REITs, for example, give 6%. And with that, every month on average come at 1,500. Mortgage payment of 4,000. Okay, remaining 2,500 can be from CPF. So basically, it's actually possible for them to upgrade without using cash to service mortgage. So this is what I mean by you can actually get very creative, okay, with property involved, okay, in your investment portfolio. Okay. And in today's context, is it still fair to assume that HDB and condo go at the same rate? So a new 4-room HDB today in similar location is already like 500, 600. Whereas a new condo of similar size and location today is actually 1.5 to 1.7. Okay. So my point here is this: if your current old HDB is already about 600,000, and yet a new HDB is also 600,000. Do you think you still can experience a lot of growth or not? Compared to a condo, so let's say a current condo is a 1.2, but new condo is 1.5 to 1.7. Okay, I think relatively speaking, the room to grow a condo is actually much higher. And of course, I think this article, this was quite old. Okay, you can see it's 12 April 2019. But then I believe based on what is happening, is going to come true. So in fact, okay, this article predicts that the new private home is going to be 2,009 on average by 2030. It looks like it's actually going to happen. Okay, so just a very short part about real estate. Like I said, tomorrow we'll talk more about the market. Today, I just want to, give you some ideas. See property as an investment instrument. Okay, don't just see it as a roof of head. And properties, there's actually 4 ways to make money. Not just on capital gain, rental yield. You can also make money from leverage and forced saving. So just a very short part on the property. Okay, so with that, I have completed what I want to share with you today. Anybody has any questions?